When thinking about equity returns, we think about the P&L and earnings growth, but at decisive turning points, it pays to focus more on what's happening with corporate balance sheets. Historically, spreads tend to tighten before equities rally at the start of a bull market. Think back to the GFC when spreads were tightening from December to March 2009, only for equities to then bottom. There are also examples of credit widening before equities at the end of a bull market. Spreads widened from July to September 2007 for equities to then peak in October 2007. So what's going on? We can think about what's happening in credit in 4 different phases in terms of the theory. Phase 1, we call this repair. Credit spreads are getting tighter as companies are restructuring their balance sheets and taking steps to cut debt and often announce deeply discounted share issues. Credit spreads fall, but equities are still falling as economic data and profit expectations haven't quite yet stabilized. Phase 2, recovery. Credit spreads continue to fall as company free cash flow rises, leverage continues to fall, and profits start to grow. This is a classic bull market. Credit spreads fall and equities rise. Phase 3, expansion. Credit spreads now start to rise. Corporate activity in M&A accelerates, leverage rises, but profits remain robust. Think 2021. M&A volumes globally were at record-breaking levels. So here credit spreads rise, but equities continue to hold up. In phase 4, defaults. Economic growth starts to slow, profit expectations fall, and balance sheets worsen. Here credit spreads rise, but equities are now falling. Let's look at the empirical evidence. So here we've looked at data since 1989 and split time periods into each of these 4 phases: repair, recovery, expansion, default, determined by what equities and credit spreads are doing at that time. Now there's a lot of data, but let's focus on the median results at the bottom of the table. In phase 1, repair, tends to be a short period of about 3 months where spreads are falling, but stocks are still falling as profits yet haven't stabilized. Phase 2, recovery, this is one of the longest periods. Spreads are falling, P multiples expand, and profit expectations rise. Phase 3, expansion, a bit shorter than phase 2, but spreads start to widen as there's signs of corporate excess, but equities are still doing okay as profit expectations hold up. Phase 4, defaults, growth slows down, spreads widen, Ps fall, and earnings expectations fall. Returns become increasingly unstable with a max upside to max drawdown ratio low. And here we can visualize these phases. Currently, we're in phase 4. Equities have been lower alongside credit spreads a bit higher since March 2022. A lot of focus has been placed on bank lending standards, which have been tightening, suggesting still weaker earnings ahead. Caution is warranted.